In 1928, a Russian economist discovered something that would get him killed. His name was Nikolai Kondratieff, and what he found was so dangerous, so threatening to those in power, that Stalin had him arrested and sent to die in a labor camp. His crime? Proving that economic collapse is not a random disaster. It's a cycle. Predictable, mathematical, inevitable. And right now, in late 2024, that same cycle is screaming a warning that almost nobody is hearing. The crash is coming. Not someday. Not maybe. 2026. Let me show you why the mathematics leave no room for doubt. Every 50 to 60 years, the global economy goes through 4 seasons. Spring, the recovery after a crisis. Summer, the boom, years when everyone feels rich. Autumn, the plateau where growth slows but nobody wants to admit the party is ending. And winter, the collapse, where decades of accumulated debt and speculation come crashing down all at once. Kondratieff proved this pattern by studying 200 years of economic data, price levels, interest rates, wages, production. He found that these waves moved with the precision of a metronome. The crashes of 1873, 1929, and 2008 weren't accidents. They were winter arriving right on schedule. Here's what's terrifying. The winter of 2008 should have been catastrophic. Banks should have failed by the hundreds. Unemployment should have hit Great Depression levels. The entire system should have collapsed and been rebuilt from scratch. But governments panicked. Central banks printed $10 trillion. Interest rates were slashed to zero. They bailed out every bank, every corporation, every bad investment that should have been wiped out. They stopped winter from finishing its job. And here's the thing about stopping winter. You can't. You can only delay it. And every year you delay makes it worse when it finally arrives. Since 2008, global debt has exploded. In 2008, total world debt was $175 trillion. Today, it's over $307 trillion. That's a 75% increase in just 15 years. U.S. government debt went from $10 trillion to $36 trillion. Corporate debt doubled. Consumer debt hit record highs. We didn't recover from 2008. We just borrowed more money to pretend everything was fine. The winter that was supposed to cleanse the system in 2008 is still waiting. It's been building pressure for 16 years. And now, multiple cycles are converging on the exact same moment. 2026. Let me show you the math. The Kondratieff wave peaks every 50 to 60 years. The last peak was in the late 1960 seconds, early 1970 seconds. That's when the post-war boom ended and stagflation began. Add 50 to 60 years. You get 2020 to 2030. We're in the window right now, but there's a second cycle layered on top, the debt supercycle, which measures how long it takes for debt to become mathematically unpayable. This cycle runs every 70 to 80 years. The last time was 1930 to 1933, the Great Depression. Add 70 to 80 years. You get 2010 to 2023. We've already crossed the threshold. Then there's the generational cycle. Every 80 to 90 years, everyone who remembers the last crisis dies. The lessons are forgotten. The guardrails are removed. The same mistakes get repeated. The generation that lived through the Great Depression is gone. Nobody alive today has experienced a true systemic collapse. We've forgotten what it looks like, what it feels like, how it destroys lives. This creates the psychological conditions for disaster. The last generational peak was 1929 to 1933. Add 80 to 90 years. You get 2019 to 2023. All 3 cycles, the long wave, the debt supercycle, the generational cycle, they're all pointing at the same 5-year window, 2022 to 2027. And within that window, the most dangerous year, the year where the maximum stress hits, is 2026. But it gets more specific. There are warning indicators that tell us exactly when the crisis will strike. The first is the yield curve. This measures the difference between short-term and long-term interest rates. Every single recession since 1950 has been preceded by something called an inversion, when short-term rates rise above long-term rates. It's never been wrong. Not once. The yield curve inverted in July 2022. It stayed inverted for over 2 years, one of the longest inversions in recorded history. Then, in September 2024, it uninverted. Historically, recessions begin 6 to 18 months after the curve uninverts. September 2024 plus 6 to 18 months equals March 2025 to March 2026. That's not a guess. That's history repeating with mechanical precision. The second indicator is corporate credit spreads. This measures the risk premium investors demand for lending to corporations versus safe government bonds. When spreads are tight, it means nobody's worried. When they widen dramatically, it means investors are fleeing to safety. Spreads always spike 12 to 24 months before a crisis. They started widening in late 2023. Late 2023 plus 12 to 24 months gives us late 2025 to late 2026. The third indicator is money velocity, how fast money moves through the economy. When confidence is high, money circulates quickly. When fear sets in, people hoard cash and velocity drops. Money velocity peaked in early 2022 and has been falling ever since. The historical lag between peak velocity and recession onset is 24 to 36 months. Early 2022 plus 24 to 36 months gives us early 2024 to early 2025. We're already in that danger zone. The fourth indicator might be the most specific. Commercial real estate. There's $1.5 trillion in commercial real estate loans that need to be refinanced between now and 2027. These loans were written when interest rates were 2%. They're being refinanced at 7 to 9%. The buildings can't support the debt. The math doesn't work. Defaults are starting to cascade right now. When commercial real estate collapses, regional banks fail. When regional banks fail, credit markets freeze. When credit freezes, the economy stops. The refinancing cliff is steepest in the first and second quarters of 2026. That's your timing. But here's what makes this crisis different from every other Kondratieff winter in history. In the past, bubbles formed in one sector. Real estate in 2008. Tech stocks in 2000, the stock market in 1929. But the money printing since 2008 didn't just inflate one bubble, it inflated everything. Stocks hit all-time highs, bonds hit all-time highs, real estate hit all-time highs. Cryptocurrencies created their own bubble. Art, collectibles, even Pokemon cards reached absurd valuations. Everything went up together because the Federal Reserve was pumping trillions into the system. This creates a catastrophic problem. When everything is in a bubble, there's nowhere to hide when it pops. In 2008, you could flee to bonds. In 2000, real estate was safe. In 1929, bonds eventually became safe after the initial shock. But in 2026, everything deflates together. Stocks, bonds, real estate, crypto, all falling simultaneously. This is the everything bubble. And when it bursts, there will be no safe haven except cash and gold. The interconnection across all asset classes is unprecedented. This isn't just another recession. This is a systemic reset. Let me walk you through what the crisis will look like as it unfolds. Phase 1 is the crack. Something breaks. Maybe it's a major bank failure. Maybe it's a sovereign debt crisis in Europe. Maybe it's the Chinese real estate market imploding. The specific trigger doesn't matter. What matters is that after years of tension, a crack appears. Authorities will immediately downplay it. They'll call it isolated, contained, nothing systemic. They'll point to low unemployment and strong GDP growth. They'll say the fundamentals are solid. This is what they always say right before everything collapses. The crack will likely appear in late 2025 or very early 2026. Phase 2 is contagion. The crack spreads. If a bank failed, depositors panic and pull money from other banks. If a country defaulted, investors question other countries. Fear becomes self-fulfilling. Credit markets freeze. Nobody wants to lend because nobody knows who's solvent. This is what happened in September 2008 after Lehman Brothers fell. The entire credit system locked up for weeks. Companies couldn't make payroll. The contagion phase lasts 2 to 6 months. In our timeline, that's spring and early summer 2026. Phase 3 is intervention. Governments and central banks panic and throw everything at the problem. Interest rates are slashed back to zero or below. Trillions are printed. Banks are bailed out again. Massive stimulus floods the economy. Markets stabilize temporarily. Everyone breathes a sigh of relief and thinks the worst is over. But it's not. The intervention doesn't fix the underlying problem. It just buys time. This phase lasts 3 to 12 months. Summer through fall, 2026. Phase 4 is the secondary collapse. This is when people realize the intervention didn't work. The rally fades. Markets fall again, this time faster and harder. Unemployment spikes. Bankruptcies accelerate. Tax revenues collapse. Social unrest grows. This is the heart of the Kondratieff winter. This phase lasts 18 to 36 months. Late 2026 through 2028. This is when fortunes are destroyed and generational wealth is transferred from the unprepared to the prepared. Phase 5 is stabilization and reset. After the system has been purged, after bad debts are liquidated, after asset prices fall to levels supported by actual value rather than speculation, a foundation for recovery is established. But this doesn't arrive until 2029 or 2030 at the earliest. The people who understand Kondratieff winters don't try to time the exact top. They prepare early. They build cash during the autumn phase, which is right now. They shed debt. They don't chase speculative gains just because everyone else is getting rich. They accept short-term underperformance in exchange for survival and the opportunity to buy assets at 30 cents on the dollar during the chaos. History shows that fortunes made during Kondratieff winters are generational. The investors who bought stocks in 1932 at the depths of the Depression saw returns that will never be matched in normal times. The investors who bought foreclosed real estate in 2009 and 2010 built wealth that will last for generations. These opportunities only come once every 50 to 80 years. If you're prepared, if you have capital when everyone else is desperate, you can buy assets for a fraction of their value. Those assets eventually recover, and that 30 cents becomes $1. That's a 300% return. But preparation requires discipline. Right now, everyone seems to be making money. Your neighbors brag about investment gains. Financial media celebrates new highs. Experts say technology has changed the rules, and this time is different. Staying cautious feels like you're missing out. This is the test. Can you resist chasing returns in autumn knowing that winter is coming? The specific actions depend on your situation. If you're heavily invested in stocks, history suggests reducing exposure dramatically. Not selling everything, but shifting from 90% stocks to maybe 40 or 50%, building a cash position to deploy when prices collapse. If you carry debt, credit cards, auto loans, personal loans, paying it down becomes the priority. Debt is an anchor in winter. It forces you to sell at the worst time. Being debt-free gives you flexibility to wait and buy when others are forced to sell. The psychological preparation might be more important than the financial preparation. When your portfolio has fallen 50% and is still falling, when the media predicts the end of capitalism, the temptation to panic and sell is overwhelming. This is precisely when you need to be buying. But having that resolve requires mental conditioning before the crisis hits. Study past crises. Read accounts from people who lived through the Depression. Understand that what feels like the end of the world is actually the reset that creates opportunity. Could the cycles be wrong this time? Theoretically possible. But these patterns aren't driven by technology or policy. They're driven by human psychology and the mathematical limits of debt. Technology changes how we produce. Policy changes how governments respond. But neither changes the fundamental boom-bust recovery pattern. What makes 2026 so compelling is that we can see the stress building in real time. Commercial real estate default rising, bank reserves tightening, consumer savings falling, credit card delinquencies increasing, corporate margins compressing. Each would be concerning alone. Together, they're painting a picture of an economy in the final stage before collapse. The yield curve uninversion in September 2024 was the starting gun. The countdown began. 6 to 18 months from that moment. The window closes in spring 2026. The commercial real estate refinancing crisis peaks in the first half of 2026. The generational cycle reaches 97 years since 1929. The delayed Kondratieff winter that should have happened in 2008 reaches its breaking point when accumulated debt becomes impossible to service. This isn't prophecy. It's pattern recognition. The same patterns that predicted 1,873, 1,929, 2008. We're not special. This generation isn't exempt. The cycle continues. When 2026 arrives and the crisis unfolds, most will claim nobody saw it coming. They'll call it a black swan, an unpredictable disaster. But it's not unpredictable. It's exactly what the cycles forecast. What Kondratieff mapped out a century ago. The information is there. The patterns are clear. The only question is whether you're willing to see them. If you're hearing this now, you have time. Not much, but enough. Enough to shift assets. Enough to build reserves. Enough to prepare. By this time next year, the crack will likely appear. By spring 2026, contagion. By summer, intervention. By fall, the secondary collapse. The crash isn't coming to destroy your future. It's coming to reset the system, to purge the excesses, to clear the way for the next cycle. Every winter has been followed by spring. The question isn't whether the system survives. It will. The question is whether you survive with your capital and your understanding intact. That's what separates those who emerge wealthy from those who emerge broken. The hidden cycle is pointing at 2026. The math is clear. The precedents are documented. The warning signs are flashing right now. The only thing left is your decision. Prepare while there's time, or hope the cycle is wrong. History suggests hoping against the cycle is a very expensive bet. Winter is coming. Will you be ready?